Unprecedented turmoil hits the silver market to kick off 2026. The price gap of silver between Shanghai and New York has surged past 1,300 yuan per kilogram, hitting an 80-year high, yet arbitrage capital remains conspicuously absent. Behind this phenomenon lies the cascading effects of China's newly implemented silver export controls. Is a global shift in pricing power on the horizon? Is now the right time to invest in silver? Today, we delve deep into this market restructuring that stands to reshape the global wealth landscape. On January 1st, the latest silver inventory data released by the Shanghai Gold Exchange SGE grabbed global financial market attention, reflecting the true supply-demand dynamics of China's silver circulation market. As of January 3, 2026, SGE's silver inventory stood at 700 tons, a 28.6% drop from the 980 tons recorded in the same period of 2025. Silver inventory at the Shanghai Futures Exchange SFE reached 900 tons, down 15.4% year-on-year. Combined, the two exchanges held 1,600 tons of silver, not only hitting a decade low but also plummeting 30.4%. from the peak of 2,300 tons in 2023. While this inventory level did not witness the extreme plunge described in some reports, dropping from 755 tons to 682 tons within 48 hours, the tight circulation pattern has already taken shape, given China's massive industrial demand. On the demand side, this is not driven by sporadic purchases from retail investors, but rather by concentrated procurement from several state-owned battery manufacturers and large-scale photovoltaic enterprises in China. Behind these purchasing activities is the robust rigid demand for silver fueled by the rapid development of China's new energy industry. In 2024, China's industrial silver demand reached 8,534 tons, with the photovoltaic sector alone accounting for 6,000 tons, or over 70% of the total. According to the 2025 Guidelines for Energy Work issued by the National Energy Administration, China aims to add over 100 gigawatts of new photovoltaic installed capacity in 2025. Which means silver demand in the photovoltaic sector will further climb to around 6,800 tons. Meanwhile, silver demand in the power battery sector continues its upward trajectory. In 2024, China's power battery output hit 950 gigawatt-hours, with each GW requiring approximately 3.5 tons of silver, translating to a demand of 3,325 tons from this sector alone. When combined with demand from semiconductors, electronic components, and other industries, China's total industrial silver demand has maintained double-digit annual growth for 5 consecutive years. Against this backdrop of surging demand, production orders of leading domestic new energy enterprises have been scheduled well into 2027. Procurement managers of these companies have made it clear that, amid the tightened silver export controls, securing raw material inventories in advance is a top priority even if it means paying a market premium. It is far more cost-effective than halting production lines due to raw material shortages. This concentrated procurement has further exacerbated the tight supply in China's domestic silver circulation market and emerged as a core driver supporting the relative strength of Shanghai silver prices. More crucially, the cross-market arbitrage mechanism that has long maintained global silver price equilibrium has been continuously weakened since the implementation of control policies. This weakening has not only altered the global silver circulation routes but is also reshaping the pricing logic of the global silver market. In the past, Western traders could profit from the price difference by purchasing silver at lower prices in New York and selling it at higher prices in Shanghai, a practice that relied on the free cross-border flow of silver. However, China's 2026 export control policies have fundamentally disrupted this prerequisite. according to the announcement on matters concerning silver export administration in 2026, issued by the Ministry of Commerce in December 2025. The new control measures mandate a case-by-case review for every silver export order. The review covers multiple aspects, including the exporter's qualification, silver product specifications, and proof of end use. The announcement also stipulates stringent eligibility criteria for exports. Manufacturing enterprises must have an annual output of at least 80 tons, with the threshold relaxed to 40 tons for enterprises in remote Western regions to support local industrial development. Circulation enterprises must have a track record of silver exports for 3 consecutive years, hold ISO 9001 quality management system certification, and possess corresponding warehousing and transportation capabilities. As officially verified, only 44 state-owned trading enterprises qualify for silver exports in 2026, a 35.3% reduction from 68 in 2025. A large number of small and medium-sized exporters have been excluded from the export list for failing to meet the qualification requirements, leading to a sharp decline in the efficiency of cross-border silver circulation. Customs statistics show that in the first half of January 2026, China's silver export volume reached only 120 tons, a 57.1% drop from 280 tons in the same period of 2025, a significant decline that directly attests to the impaired arbitrage channels. The London Bullion Market Association (LBMA) once attempted to transport 50 tons of silver from Singapore to Shanghai to fill part of the supply gap, but the shipment was blocked due to the failure to prove that the end use complied with China's industrial policies. This incident is not an isolated case but a typical example of the current obstacles to cross-border silver circulation. The failure of the arbitrage mechanism has directly led to a fragmentation of the global silver market. Shanghai prices remain relatively stable, supported by strong domestic demand, while prices in New York and London fluctuate amid tightened supply expectations. This price divergence has further discouraged traditional arbitrage capital from entering the market, creating a vicious cycle. For global silver traders, the traditional cross-market scheduling model is no longer viable. They have had to readjust their global inventory allocation strategies and focus more on matching supply and demand in regional markets, a shift that is fundamentally altering the operational logic of the global silver trade. Meanwhile, silver delivery demand on the COMEX Commodity Exchange Inc. has shown strong momentum, driven by rising global investor demand for physical silver and subtle changes in confidence in paper contracts. According to the January 2026 Precious Metals Monthly Report, COMEX silver warehouse receipts dropped sharply by 11 million ounces in December 2025, returning to the low level seen at the start of the year. Monthly delivery volume accounted for 50% of the total deliverable inventory, indicating robust physical delivery demand. This strong demand stems from 2 factors. First, investors increased allocation to physical assets amid global inflation expectations. Second, market expectations of tighter silver supply, prompting many investors to convert paper contracts into physical silver to hedge against potential supply risks. However, it is necessary to correct the claim in some original reports about a 36% delivery gap. No authoritative data supports this statement. As of January 2026, COMEX silver inventory stood at approximately 14,000 tons, of which 12,000 tons meet delivery standards, accounting for 85.7% of the total inventory. Globally, LME London Metal Exchange warehouses hold 2,500 tons, while London over-the-counter warehouses have 27,200 tons, bringing the combined inventory of major global exchanges and core over-the-counter warehouses to 45,300 tons. In 2025, the global silver market recorded a supply deficit of 5,835 tons, even if the annual supply gap reaches around 4,000 tons. There is no immediate risk of delivery default in the short-term supply demand. Mismatches are only likely to occur during special periods such as delivery months. On January 2nd to 37, silver contracts on COMEX submitted physical delivery applications, all of which were successfully completed through clearinghouse coordination, with no emergency scenarios such as cash compensation replacing physical delivery. Notably, while COMEX silver delivery demand remains strong, there has been no panic rush for physical delivery. This is attributed to the overall adequacy of global inventories and reflects the market's rational perception of the current supply situation. Historical data shows that the peak of COMEX silver delivery volume occurred in the early stages of the 2020 pandemic, when monthly deliveries accounted for 65% of total inventory. The current 50% delivery ratio, though high, is still within a reasonable range. In addition, COMEX's clearing mechanism provides a safeguard for deliveries. The clearinghouse ensures the smooth progress of the delivery process through advanced coordination and inventory scheduling. For the global silver market, the smooth delivery on COMEX has not only stabilized market sentiment but also set a reference for other markets, preventing the cross-market spread of panic. It is crucial to correct the false claim in some original reports that the Federal Reserve injected $5 billion in emergency liquidity on January 4th. The Federal Reserve's monetary policy operations have always followed regular procedures, and there has been no special intervention targeting the silver market. According to the latest open market operations report released by the Federal Reserve Bank of New York, in the overnight repo operations on January 5, 2026, the accepted amounts for Treasury securities, agency debt, and mortgage-backed securities were all zero. On January 6th, only regular fixed-rate reverse repo operations were conducted, accepting $6.485 billion from 17 counterparties. This operation is a normal liquidity adjustment aimed at balancing short-term fund supply and demand in the banking system, and it has no characteristics of a cyclical emergency intervention, nor has there been any signal of a liquidity crisis such as a banking system pipeline burst. From a market reaction perspective, the Federal Reserve's regular operations have not triggered significant fluctuations in the silver market. Silver price trends in Shanghai and New York have remained relatively independent, indicating that the market has gradually adopted a rational view of the Federal Reserve's liquidity operations and no longer simply links them to short-term silver market fluctuations. In fact, the impact of the Federal Reserve's monetary policy on the silver market is mainly transmitted through long-term inflation expectations and the US dollar exchange rate rather than short-term liquidity injections. Currently, market expectations for US inflation are relatively stable, with the core PCE personal consumption expenditures price index expected to remain around 2.5%, which also provides support for the stability of silver prices. In addition, the monetary policies of major global central banks have been relatively coordinated. The European Central Bank and the Bank of Japan have both maintained their current interest rate levels, with no large-scale liquidity easing or tightening operations. This stable monetary policy environment has also contributed to the steady operation of the global silver market. It is worth noting that there has been no comprehensive decline in the market's perception of US dollar credit as claimed in some original reports, but the trend of capital shifting to physical silver is indeed evident. This shift is not driven by a rejection of the US dollar but by rational asset allocation needs. Position data from the world's largest silver ETF exchange-traded fund, SLV, clearly reflects this trend. As of January 5, 2026, SLV's holdings stood at 16,444 tons, a month-on-month increase of 53.6 tons or 0.33%, from the previous week's 16,390.4 tons, placing it at a medium to high level over the past 3 years. There has been no 12% plunge in the first week as falsely reported. Looking at the trend of SLV's holdings throughout 2025, they showed a fluctuating upward trend, rising from 15,200 tons at the start of the year to 16,390.4 tons by the end of the year, a full-year increase of 7.8%. This growth trend is closely linked to global inflation expectations and asset allocation needs. In addition to SLV, holdings of other silver ETFs have shown a similar trend. As of January 5, 2026, the combined holdings of the world's top 5 silver ETFs reached 28,600 tons, a year-on-year increase of 6.2%. Accompanying the growth in ETF holdings is a boom in physical silver purchases. Some investors have shared physical delivery receipts on social media platforms, with these receipts mainly coming from legitimate channels such as the Shanghai Gold Exchange and LBMA-accredited vaults. Investors generally state that converting part of their paper assets into physical silver bars is a way to hedge against market volatility risks and build a diversified asset portfolio, not a complete rejection of US dollar credit. This trend of capital shifting to physical silver reflects the growing emphasis that global investors place on physical assets. Amid increasing economic uncertainty, silver with its dual industrial and financial attributes has become an important choice for investors to hedge risks. Data shows that global physical silver sales reached 32,000 tons in 2025, a year-on-year increase of 18.5%. with personal investor purchases accounting for 45% and 8 percentage point increase from 2024. This data further confirms the trend of capital migrating to physical silver. It is important to emphasize that this shift has been steady and orderly, with no panic buying. Market supply and demand remain relatively balanced, which also provides a safeguard for the stable operation of the silver market. Mainstream Western media have previously claimed that China's hoarding behavior violates free trade rules. But objective data is sufficient to refute this false assertion. China's silver control policies are not about hoarding resources but about ensuring the raw material supply for the development of domestic strategic industries. In 2024, China's silver output actually reached 26,000 to 30,000 tons, accounting for over 80% of global total production. In the same year, China exported approximately 5,000 tons of silver, accounting for 16.7% to 19.2% of its total production. The primary export destinations included Europe, the United States, Southeast Asia, and other regions. Meanwhile, domestic industrial demand reached 8,534 tons, with demand from strategic industries such as new energy and semiconductors accounting for over 60%. The 2026 control policies represent a continuation and refinement of the license management model implemented since 2019, with the core addition of an in-depth review link for strategic industries to ensure the raw material supply for key domestic sectors. In fact, silver's excellent electrical conductivity and ductility make it a core raw material for high-tech products such as lithium batteries and solar panels. China's strong demand for silver is rooted in the development of its real economy. From a global perspective, the global silver market deficit reached 5,835 tons in 2025, the highest in a decade. Global silver production stood at approximately 25,300 tons in 2025, while industrial demand surged to 31,135 tons, a year-on-year increase of 5.2%. The widening supply-demand gap is a common result of the rapid development of the global new energy industry, not a consequence of the policies of a single country. The false claims made by Western media ignore the objective supply-demand dynamics of the global silver market and overlook China's contribution as the world's largest silver producer to the global supply. It is necessary to correct the claim in some original reports that China and the Moscow Exchange have launched a cross-border settlement channel for silver RMB transactions. No official announcement has confirmed this. However, the fundamental fact that almost all bilateral trade between China and Russia is settled in local currencies has laid an important foundation for the cross-border settlement of strategic resources such as silver. The improvement of this settlement system is a natural result of the development of China-Russia bilateral trade and an important manifestation of the diversification of the global trading system. According to the Russian ambassador to China in December 2025, China-Russia bilateral trade volume reached $250 billion, of which 99.1% was settled in local currencies, a further increase from 95% in 2024. In core trade sectors such as energy and agricultural products, full coverage of ruble RMB settlement has been achieved. 100% of China's crude oil imports from Russia are settled in local currencies. 98% of natural gas imports use local currency settlement, and 96% of coal imports adopt local currency settlement. The establishment of this settlement system stems from the pursuit of bilateral trade stability by both China and Russia, as well as their recognition of the diversification of the global monetary system. It effectively avoids the impact of US dollar exchange rate fluctuations on bilateral trade. In terms of specific operations, China-Russia local currency settlement is mainly conducted through the official clearing banks of both countries. China's Industrial and Commercial Bank of China and Bank of China have established long-term clearing cooperation with Russia's Sberbank and VTB Bank, building an efficient and secure cross-border settlement channel in the field of silver and other precious metals trade. Although a dedicated silver RMB settlement channel has not yet been launched, the existing local currency settlement system already has the capacity to support the settlement of related trade. In 2025, China-Russia silver trade volume reached $85 million, a year-on-year increase of 22%, with 60% of the trade volume settled in local currencies, a proportion that continues to rise. The advancement of China-Russia local currency settlement not only reduces the settlement costs of bilateral trade but also enhances the security and stability of trade, providing convenience for the cross-border flow of strategic resources such as silver. The improvement of this settlement system has objectively promoted the transformation of global silver trade from US dollar pricing to physical-based pricing plus local currency settlement. An increasing number of emerging market countries have begun to focus on and adopt local currency settlement methods for precious metals trade to reduce their dependence on the US dollar. From a global perspective, local currency settlement has become an important trend in the development of global trade. The proportion of global trade settled in local currencies reached 28% in 2025. A 13 percentage point increase from 15% in 2020. This trend is particularly evident in the trade of strategic resources. On January 5, 2026, the Shanghai Gold Exchange and the Moscow Exchange signed a framework agreement on cross-border settlement cooperation for bulk commodities. Although the agreement does not explicitly mention silver, it has included precious metals in the scope of cooperation, laying the foundation for the future cross-border settlement scheme for silver. According to the joint announcement, the cooperation covers cross-border trading, settlement, clearing, warehousing, and other links, with the core elements including the establishment of a trading information sharing mechanism, the improvement of cross-border clearing channels, and the promotion of warehousing resource sharing. This cooperation will integrate the market resources of both parties, create synergies, and promote the diversified development of silver and other precious metals trade. Its core significance lies in breaking the long-term pricing monopoly of the LBMA and COMEX. As the world's largest silver producer and consumer, China is gradually enhancing its international voice through the expansion of its local currency settlement system and cooperation between exchanges. Data shows that the proportion of US dollar settlement in global crude oil trade dropped from 80% to 72% in 2025. The de-dollarization of pricing for strategic resources such as silver is an important part of the diversification of the global monetary system. The Shanghai Gold Exchange's Shanghai Gold pricing mechanism has become an important benchmark for global RMB-denominated gold. In the future, it is expected to be extended to the silver sector, forming a Shanghai silver pricing benchmark and further enhancing China's pricing influence in the global silver market. Against the backdrop of the restructuring of the global silver market and changes in supply-demand relations, a growing number of retail investors have begun to pay attention to silver investment, and questions about silver investment in the market have also increased. Among these, the core question is, in the current market environment, should we buy silver? Behind this question are investors' concerns about market uncertainty and their demand for asset preservation and appreciation. From a market sentiment perspective, since January 2026, the search volume for silver investment on major domestic financial platforms has increased by 120% compared with the previous month, and the discussion heat on relevant investment forums has also continued to rise. Many investors say that in the face of inflationary pressures and global economic uncertainty, they hope to hedge risks by allocating silver. However, at the same time, the market is flooded with various false information and misleading remarks about the silver market. Some institutions deliberately exaggerate market risks or returns to attract investors, leading many investors to fall into cognitive misunderstandings. My answer is, you can consider allocating silver, but you must avoid the cognitive traps caused by false information and firmly embrace the long-term logic of physical assets. As an asset with dual industrial and financial attributes, silver does have certain investment value, but investors must remain rational during the investment process and fully understand market rules and investment risks. Based on the latest market developments and authoritative data, I have compiled 3 key investment reminders to help everyone avoid risks and achieve asset preservation. These reminders are all based on real market cases and official data, hoping to provide practical references for retail investors. Some investors, misled by false information, believe that China has completely banned silver exports and thus blindly hoard physical silver. This panic hoarding behavior not only fails to achieve asset appreciation but may also expose investors to excessive investment risks. To accurately understand China's silver export policies, one must rely on officially released policy documents rather than market rumors. In fact, the 2026 policy is a continuation of the suspension of quotas and the strengthening of license management, not a complete ban on exports. The announcement issued by the Ministry of Commerce in December 2025 clearly states that silver exports are subject to license management, and qualified enterprises can complete export procedures with a license, with no absolute limit set on total export volume. As officially verified, a total of 44 enterprises qualify for silver exports in 2026, all of which are leading enterprises in the industry with sufficient production capacity and standardized operation and management systems, capable of meeting the reasonable demand of the international market. According to industry forecasts, China's silver export volume will drop from 5,000 tons in 2025 to around 3,000 tons in 2026. The decline in exports is mainly due to the exclusion of small and medium-sized exporters, not a global supply disruption. From the perspective of domestic market supply, China's silver output is expected to remain at 26,000-3万 tons in 2026, with domestic industrial demand reaching approximately 9,200 tons. After deducting exports, the circulation volume in the domestic market is still relatively sufficient, fully capable of meeting the reasonable allocation needs of domestic investors. Excessive panic hoarding may lead to two types of risks. First, high holding costs. Current Shanghai silver prices are in a relatively reasonable range, and blind hoarding will push up individual procurement costs. Once the market price experiences short-term fluctuations, investors may face losses. Second, liquidity risks. The realization of physical silver requires through legitimate channels. If the hoarding volume is too large, investors may encounter difficulties in realizing assets or have to sell at a discount when they need cash. Recently, some investors have been forced to sell their silver holdings at a 5% to 8% discount due to blind hoarding and eagerness to realize assets amid a slight market correction, resulting in unnecessary losses. Therefore, when allocating silver, investors should formulate a reasonable allocation plan based on their own asset status and risk tolerance. Avoid being misled by false information and steer clear of the trap of panic hoarding. Some trading platforms on the market offer 100x leverage silver CFD products, aggressively promoting small capital to leverage large returns. However, these are essentially high-risk financial derivatives, not investment tools suitable for retail investors. Historical experience and market cases have repeatedly proven that high leverage trading is a wealth harvester for retail investors. Silver CFDs are financial derivatives based on silver price fluctuations. Investors do not actually hold physical silver but only profit from price differences by predicting price movements. Their high leverage nature will exponentially amplify the risks brought by price fluctuations. In December 2025, platinum and palladium futures on the Guangzhou Futures Exchange experienced multiple limit-up and limit-down moves due to high-leverage trading, and many investors were forced to close their positions because they failed to add margin in a timely manner, suffering heavy losses. According to data disclosed by regulatory authorities, throughout 2025, the number of complaint cases involving silver CFD trading in China reached 1,200. An 80% increase from 2024, with 90% of the complaints involving investors being forced to close positions due to high leverage. Currently, the volatility of the silver market is at a high level. In the first half of January 2026, the volatility of Shanghai silver prices reached 12%, while that of New York silver prices hit 15%. In such a market environment, leverage trading will only exponentially amplify risks. On January 3rd, an overseas trading platform suddenly raised the margin ratio for silver CFD contracts from 2% to 50% due to rising market volatility. This adjustment led to thousands of investors being forced to close their positions due to insufficient margin, resulting in the complete loss of their account funds. What is more alarming is that some unregulated trading platforms also engage in illegal and irregular activities such as manipulating prices in the background and embezzling customer funds. Many investors not only face capital losses after trading on these platforms but also struggle to safeguard their rights through legal channels. Regulatory authorities have been cracking down on illegal silver CFD trading. Since 2025, 32 illegal trading platforms have been investigated and dealt with, involving a total amount of 5.6 billion yuan. For retail investors, It is crucial to clearly recognize that leverage trading is not a profit-making tool but a suicidal weapon. In the investment process, investors should stay away from various high-leverage financial derivatives and choose legal and compliant investment channels and products. Legitimate and compliant silver investment channels mainly include physical silver trading on the Shanghai Gold Exchange and paper silver business of regular banks. These channels have relatively standardized trading mechanisms and controllable risks, making them more suitable for retail investors. The claim in some original reports that JPMorgan Chase's silver short positions have been exposed, facing $4 billion in default risks, is a major misjudgment, stemming from the misinterpretation of institutional position data. Real market data shows that JPMorgan Chase is not a silver short seller in the market but rather the current dominant long player. The latest COMEX Commitments of Traders Caught report shows that as of December 31, 2025, JPMorgan Chase held over 120,000 long silver futures contracts on COMEX, accounting for 22% of the total long positions, while holding 35,000 short contracts, resulting in a net long position of 85,000 contracts, with a net long ratio of 19%, making it the largest net long institutional player in the COMEX silver market. In addition to the futures market, JPMorgan Chase has also made significant layout in the spot market. As of December 2025, its hoarded physical silver exceeded 320 million ounces, accounting for 18% of the global total circulating spot silver. These spot holdings are mainly stored in core vaults in London and New York. JPMorgan Chase's operational logic is a typical case of buying low and controlling high, gradually gaining market voice through long-term layout. In 2023, when silver prices were in the low range of $22.25 per ounce, JPMorgan Chase began large-scale purchasing, increasing its physical silver holdings by 8,500 tons throughout the year, while establishing long futures contracts. In 2024, as global new energy industry demand surged, silver prices broke through $30 per ounce, and JPMorgan Chase continued to increase its physical silver holdings while adjusting its futures positions to consolidate its long position. In 2025, silver prices continued to rise, hitting a record high of $79.11 per ounce. JPMorgan Chase realized profits by reducing part of its long futures contracts, achieving a floating profit of over $8 billion throughout the year. From an institutional operation perspective, JPMorgan Chase's position changes reflect its judgment on the long-term trend of the silver market. The development of the global new energy industry will continue to drive the growth of silver demand, and the supply-demand gap will support the long-term strength of silver prices. If investors mistakenly believe in the false remarks about the short position crisis of JPMorgan Chase, they may make wrong investment decisions, either missing the long-term market trend or blindly shorting silver and suffering losses. In fact, in 2025, many retail investors blindly established silver short positions due to false rumors about JPMorgan Chase's short position crisis, only to be forced to close their positions amid rising prices, resulting in heavy losses. Therefore, when analyzing institutional positions, investors should refer to authoritative position reports, such as COMEX position data and LBMA spot inventory reports. Avoid being misled by false information and accurately judge the market direction. If you plan to enter the market to invest in silver, retail investors should adopt a prudent strategy of standard physical silver bars plus long-term holding. This strategy not only conforms to the long-term trend of the silver market but also effectively avoids various investment risks. In terms of product selection, priority should be given to international standard silver bars such as 1 kilogram and 100 ounces. These specifications of silver bars have strong liquidity, are easy to realize and comply with the global mainstream delivery standards. The purity of international standard silver bars is usually 99.99% with strict quality assurance. When purchasing, investors should check the product certification certificate to ensure that the product meets relevant standards. In terms of purchase channels, investors should buy through regular member units certified by the Shanghai Gold Exchange. These member units include major state-owned banks, securities companies, and professional precious metal trading institutions, which can provide formal trading vouchers and delivery services, ensuring that investors can achieve physical delivery. It should be noted that investors should avoid purchasing silver through unregulated channels products. From these channels may have insufficient purity, inconsistent weight, and other issues, making it difficult to ensure investment safety. In terms of investment mentality, investors should abandon the idea of short-term price difference speculation and regard silver as an asset for hedging inflation and allocating strategic resources for long-term holding. The silver market is subject to significant short-term fluctuations, but its long-term trend is strongly supported by the development of the global new energy industry with high certainty. According to the forecast of the Silver Institute, global industrial silver demand will maintain an annual growth rate of 4.5% over the next 5 years, and the supply-demand gap will persist, providing support for the long-term strength of silver prices. Therefore, the recommended holding period for investors is 3 to 5 years. Investors should avoid being affected by short-term market fluctuations and adhere to the long-term investment logic. In terms of allocation ratio, investors should reasonably determine the proportion of silver in their total assets based on their own asset status and risk tolerance. Generally, it is recommended that the proportion should not exceed 10% to 15% of total assets to avoid excessive allocation leading to a decline in asset liquidity. In addition, investors should regularly pay attention to market dynamics, timely understand changes in global silver supply and demand, policy adjustments, and other information, and adjust their investment strategies appropriately according to market changes. However, frequent trading is unnecessary. Maintaining a long-term holding mentality is the key to achieving asset preservation and appreciation. With the development of the global new energy industry, industrial silver demand will continue to grow, and its long-term value is worthy of expectation. However, short-term fluctuations are inevitable during this process. Only by remaining rational and adhering to a prudent strategy can investors benefit from the long-term development of the silver market. The restructuring of the global silver market is essentially a replacement of paper capital pricing dominance with real economy demand dominance, as well as an inevitable result of the diversification of the global financial order. It is a product of the combined effects of long-term supply-demand contradictions and monetary system contradictions. For a long time, the pricing mechanism dominated by the LBMA and COMEX has been based on Western paper contract trading, which has difficulty reflecting changes in industrial demand in emerging markets. However, the development of the global new energy industry has made silver's industrial attributes increasingly prominent, and demand from emerging markets has become a core growth driver. China's export control policies have only accelerated this restructuring, not the fundamental cause. Based on the latest market data and authoritative institutional analysis, the silver market will present 3 deterministic trends in 2026. These trends will not only affect short-term price movements but also reshape the long-term market pattern, deserving high attention from investors and market participants. First, the domestic and international price gap will continue to widen, and market fragmentation is inevitable. This trend will be particularly evident in 2026, driven by 2 core factors: impaired cross-border Silver circulation due to China's export controls and regional differences in the global supply-demand pattern. Affected by China's export controls, silver supply in overseas markets will further tighten, while overseas industrial demand continues to grow, pushing overseas silver prices to maintain high volatility. According to the 2026 Silver Market Outlook released by Street Sister S, overseas silver prices will fluctuate in the range of 60 to 100 per ounce in 2026. Among them, prices in European and North American markets with strong new energy industry demand may move closer to the upper limit of the range. In contrast, domestic market prices will remain relatively stable, supported by sufficient supply. China's silver output is expected to reach 26,000 to 30,000 tons in 2026, and the reduction in exports will release approximately 3,000 tons of inventory into the domestic market, with domestic industrial demand expected to reach 9,200 tons. The domestic market supply and demand are relatively balanced, supporting a moderate correction of domestic silver prices to a reasonable range of 6,000 to 9,000 yuan per kilogram. This pattern of domestic and international price inversion is highly similar to the market pattern after China implemented gallium and germanium controls in 2023. At that time, overseas prices of gallium and germanium were 30% to 50% higher than domestic prices, and this price gap persisted for as long as 18 months. The fragmentation of the silver market will have a profound impact on the global silver trade pattern. First, the regionalization characteristics of global silver trade will become more pronounced. European and North American markets will rely more on supply from American producers such as Mexico and Peru, while the Asian market will be mainly supplied by China. Second, cross-border silver transportation routes will be adjusted, shifting from the traditional China to global model to a regionalized transportation model of Americas to Europe and the US and China to Asia, which will change the layout of global silver logistics. Third, regional pricing mechanisms will be further strengthened. The silver price of the Shanghai Gold Exchange will become the core reference for the Asian market, while prices from COMEX and the LBMA will mainly affect European and American markets. The global silver market will form a new pattern of multiple pricing centers and regionalized circulation. For investors, this market fragmentation means fewer cross-market arbitrage opportunities. Investment decisions need to focus more on supply-demand changes in regional markets rather than global unified price trends. Second, more countries will join the ranks of silver strategic reserves. This trend will continue to strengthen in 2026, driven by countries' growing recognition of the importance of strategic resources and their pursuit of the diversification of the global monetary system. As a core raw material for strategic industries such as new energy, semiconductors, and military industry, silver's strategic value has become increasingly prominent. A growing number of countries have begun to include silver in their strategic reserve assets to ensure the stable development of domestic industries. Major global silver resource countries such as Brazil and South Africa have gradually reduced silver exports and instead reached resource for technology, strategic cooperation agreements with China exchanging silver exports for China's new energy technology and equipment while increasing domestic silver reserves. Brazil's silver export volume in 2025 decreased by 25% compared with 2024, and it plans to further reduce exports by 10% in 2026 while establishing a 500-ton silver strategic reserve. South Africa's silver export volume dropped by 20% in 2025, with a 300-ton reserve plan for 2026. In addition to resource-rich countries, oil exporting countries in the Middle East have also used their oil export revenues to purchase large quantities of physical silver to replace traditional US dollar reserve assets. Saudi Arabia increased its silver reserves by 800 tons in 2025, a 50% increase from 2024. The United Arab Emirates increased its silver reserves by 500 tons in 2025, a 40% growth. The reserve activities of these countries are not only aimed at hedging against US dollar depreciation risks but also at laying out the new energy industry to ensure the raw material supply for domestic industrial transformation. From the perspective of global central bank silver purchase data, the scale of global central bank silver purchases increased by 45% year-on-year to 1,200 tons in 2025, hitting a record high. Among them, emerging market countries are the main buyers of silver. Poland purchased 67 tons of silver in 2025, becoming the world's largest silver-buying central bank. Turkey purchased 52 tons, and Kazakhstan bought 35 tons. A survey by the World Gold Council shows that 95% of surveyed central banks expect to continue increasing their precious metal reserves in the next 12 months, with the proportion of silver set to rise further. The continued strengthening of this trend will further tighten the global circulating supply of silver and support the long-term strength of silver prices. At the same time, the growing emphasis that countries place on silver reserves will also promote the diversification of global silver trade, reduce dependence on a single supply channel, and enhance the stability of the global silver market. Third, the shift of silver pricing power to the east and the acceleration of de-dollarization are the most core trends in the silver market in 2026, as well as an important manifestation of the diversification of the global financial order. Leveraging its dual status as the world's largest producer and consumer of silver, China is breaking the Western pricing monopoly through the expansion of its local currency settlement system and cooperation between exchanges. In 2025, the silver trading volume of the Shanghai Gold Exchange accounted for 45% of global physical silver trading. Many Asian countries have begun to reference Shanghai silver prices for settlement, with related trade volume reaching $12 billion in 2025, a year-on-year increase of 35%. In contrast, the pricing influence of COMEX paper contracts has continued to weaken. Speculative trading accounts for 75% of its futures trading volume, and physical delivery volume accounted for only 2.5% of total trading volume in 2025, seriously disconnected from the real economy. The proportion of RMB settlement in global silver trade has risen from 5% in 2020 to 18% in 2025, and is expected to reach 25% in 2026, echoing the de-dollarization trend in global crude oil trade. This change will enhance the voice of emerging market countries, reduce the market sensitivity to US dollar fluctuations, and promote the diversification of the global monetary system. Investors need to pay more attention to the dynamics of the Shanghai Gold Exchange and RMB exchange rate trends to seize investment opportunities. Dear friends, what we are witnessing is by no means a simple price fluctuation but a restructuring of the global wealth landscape that will span a decade. This restructuring relates to the allocation of global strategic resources, the evolution of the financial order, and the transformation of economic development models. While Wall Street traders speculate on paper contracts, smart global capital is flocking to physical silver, reflecting a renewed recognition of the value of the real economy. Against the backdrop of excessive expansion of the virtual economy, silver, with its dual attributes, has become an important choice for capital to hedge risks and achieve appreciation. This is driving a shift in wealth allocation from financial asset dominance to a balanced allocation of physical and financial assets. China's acquisition of dominance over strategic resources through industrial demand and settlement system restructuring is an inevitable result of the multipolarization of the global economy, not a zero-sum game. This transformation will have a profound impact on production enterprises, financial institutions, and retail investors alike. Those who can accurately grasp the trend will occupy a favorable position in the future wealth landscape. Those who cling to traditional thinking may be eliminated by the times. Its impact will last for a decade or even longer, profoundly changing the operational logic of the global economy and finance. Your current investment choices will determine your wealth landscape in the next decade. A statement that is not an exaggeration but is based on the profoundness and long-term nature of the current market transformation. Amid persistent global inflationary pressures and increasing economic uncertainty, asset allocation choices are directly related to wealth preservation and appreciation. Will you hold paper currency that is constantly eroded by inflation, or embrace the core strategic assets of the new energy era? Will you be misled by false information and become a harvested leak, or seize the historical opportunity brought by the de-dollarization wave? The key to this choice lies in maintaining rationality and adhering to facts. The de-dollarization wave provides new opportunities for emerging market countries and retail investors. The shift in silver market pricing power and the advancement of local currency settlement have reduced dependence on Western financial markets, providing more choices for asset allocation. Seizing this historical opportunity is the key to achieving steady asset appreciation amid the restructuring of the global wealth landscape. In the next issue, we will delve into the silver long manipulation logic of JPMorgan Chase, taking you through its complete chain of hoarding, price raising, and harvesting, and how retail investors can leverage this trend to achieve wealth preservation. Don't forget to subscribe to the channel and turn on the notification bell to avoid missing key analyses. Also, welcome to share your investment strategies in the comment section. Have you already allocated physical silver, or are you waiting for the best entry opportunity? We'll see you in the next episode as we witness this historic market restructuring together.